Hi everyone, I'm America Josh and welcome to our monthly webinar. This month we're talking all about managing your Australian assets while you're in the US. Feel free to drop any questions that you've got in the chat. We will be monitoring that throughout and trying to get to as many questions as we possibly can. I know a lot of the topics that we're going to be talking about tonight are deeply personal. There are lots of things that only affect some of you and not all of you. So we're going to try and make sure that we start at 30,000 feet, really cover some interesting ground, and we'll get more and more down into the weeds as we go. So bear with us. Make sure you ask your questions. We want to hear from you. We want to know that we're hitting on all the right topics. If you are new to the US, America Josh is an online resource and community. We cover almost now over 75,000 people who are either planning to move to the US or are currently in the US, mostly from Australia. And what we want to do as part of these webinars is help you find the best information and find you the best experts that we possibly can. So before I introduce tonight's fantastic expert, I am going to share a quick disclaimer because it is important that we do that. So the information in this presentation does not constitute financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situations, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. Apt Wealth Partners, AFSL and ACL 436121, ABN 49159, 583-847, Apt Wealth Home Loans powered by Smartline, ACL 385325, and America Josh LLC recommend that you obtain professional advice before making any decision in relation to your particular requirements or circumstances. There we go. It's not as fast as some of those disclaimers that you hear at the end of some other things, but I wanted to make sure I read it all out because for anyone listening, this also goes out as a podcast called Moving to America with America Josh. So enough of me. Tonight, I'm joined by John Versace from Apt Wealth Partners. John is the Director and Head of Expat Services. And I want you to talk about that, John, because it's a specific space that is just focused on this idea of having a life abroad, like a lot of the people watching tonight. You've been in financial planning for 20 years and you lead a team that works specifically with it's Australians living in the US. So John, thank you very much for giving us your time tonight. Do you want to introduce yourself? Tell us a little about what you do and what Apt does for your clients.
Yeah, beautiful. Thanks for having me, Josh. And it's a pleasure to be joining you. As you mentioned, I'm a senior advisor and a director at Apt Wealth Partners. So firstly, to introduce Apt Wealth, we're a national advice firm. We've got our offices primarily in the Melbourne CBD and the Sydney CBD. So we're an Australian licensed firm. We've been around for about 30 years and we're privately owned, around 85 employees, and look after about $3.5 billion on behalf of our clients in super and investment portfolios. Really, our role is to put together full financial strategies for our clients, looking at how you set up your assets and your cash flow in the best way to achieve your financial goals. And then we're there ongoing with our clients to make sure they stay on the right track and continue to make good, smart decisions. And we manage investments for our clients on an ongoing basis. But as you mentioned, and the reason why I'm joining you today is that we've got a specialist division that looks after individuals that have a cross-border aspect to their affairs. And it's basically all I do now is look after US Australians. It would be over 80% of my direct clientele, and really all my new clients are US Australians. And we've got a team that focuses on that space as well, because as we'll talk about, and as you'll see, it is a very specialised area, and the strategies that will make sense whilst you're living in Australia and just worried about Australian taxes are really unlikely to be effective whilst you're paying US taxes and Australian non-resident taxes. So that's something we specialise in.
Yeah, it's a particularly niche area, and I think a lot of the time we don't sort of really realize just how niche it is and how many nuances there are to that. And I'm going to launch right in because we've had thank you everyone who submitted questions. We've tried to tailor as many of these Q&As with John around what's been submitted, but also just some broad advice or broad information that we can give you. Also, just to flag, at the end of this webinar, we're going to share a link. John and his team have very kindly offered some 20-minute free consultations for everyone watching. So we'll have a link at the end of this, and it will be in the description if you're watching on YouTube or on Facebook or on LinkedIn. So be sure to stay around till the end so we can share that link. So John, in terms of these nuances that I was just talking about, superannuation is one of the ones I think that came up in almost every single question that we had submitted around self-managed super funds and super in general. I want to start as I said, at 30,000 feet, how does the IRS, so the tax department in the US, how do they look at Australian superannuation?
Yeah, it's a really good question. It's one that causes a lot of confusion out there.
10 words or less, just describe the whole.
Yeah, 10 words or less is yeah, very, very tricky to do because the simple reason, and there's a lot of frustration in the US Australian community around superannuation. The reason is because the double tax treaty between Australia and the US doesn't address superannuation, and the IRS have never come out and said, this is exactly how we're going to treat superannuation for US tax purposes. So you'll get variances of opinion out there between the specialist US Australian accountants, and it's trying to put a square peg in a round hole. Basically, it doesn't fit in the US system. So essentially, it hasn't been addressed. But the safe thing to assume is that it doesn't get treated in the same way as what the Australian system treats it. The US views super very differently, where it's likely that they'll want to tax the investment earnings on your income tax return at some point in time, whether it's along the way each year or when you're drawing out. And for most people, it's when you're drawing out, if you're in the US tax system, that you'll pay income tax on your superannuation. But you've got to be very, very careful with what you do. Even the simplest strategy, I would recommend you always speak to your US accountant. Anything you do with your superannuation, you should be checking that off to make sure it doesn't cause a US tax complication.
Yeah, so this complicated nature is basically built on the fact that they haven't actually said this is the rule. There is no... So to the people that are watching, I think, as you flagged at the very beginning, there is a frustration because it's like, surely someone can just tell me what am I meant to do? But it is somewhat, I guess, open to interpretation. Is that right? Down to...
Yeah, it definitely is. And really what the accountants are doing are looking at other parts of the US Tax Law Act and really trying to look at that and say, okay, this is how we then treat superannuation. But it is, it's uncertain because it's different to a 401k. It's different to other parts of the US financial system. And, just for example, the ability for you to go and put $50,000 into your retirement account in one hit is just such a foreign concept to anything that the US has. Things like that just create, complexity and a difference of opinion of how the US would view what that account is once you do something like that, because you can't do that with a 401k.
So in terms of if people have moved to the US, what do you generally tell people about contributing to their super if they've moved to the US, whether it's short or long term? And there's going to be some nuance, I think, when we talk about all of these topics about whether you're staying with a finite time or an unknown time. What do you sort of generally say about contributions to super?
Yeah, and that's a key point, is that the length of time you're going to be in the US will dictate a lot of the decisions you make around the financial strategies. I would say typically contributing into superannuation whilst you're living in the US is unlikely to be a strategy that you should be doing. First and foremost, you're likely to be paying your taxes in the US and primarily to the IRS. The IRS will not recognise any contributions you make into superannuation as being a tax effective way of minimising your personal income tax. So it'll be completely ineffectual for lowering your US income taxes. The benefits of contributing into superannuation, if you're someone that's over in the US for the short term, there'll be opportunities when you come home, most likely, to contribute into superannuation and make it tax effective from an Australian standpoint. So that might be the time to do it. And the lucky thing is that you've got the ability to put quite a lot in quite quickly with superannuation in Australia. So it's likely that you should wait until you get back to Australia. But as I alluded to before, putting contributions into superannuation whilst you're in the US can completely change the way the US looks at your superannuation. And that can open up a whole can of worms where there's extra filing, extra taxes, and some unintended consequences to your US tax return.
Got it. We have actually had a question that pertains exactly to this around if there are requirements like from some companies that you have to contribute. Is that sort of part of the strategy that you'd build with that person about like what do you have to do to head that off if that's a requirement for your super fund?
Yeah, and it's very different when it's a requirement for you to contribute into superannuation, and some people will move to the US for an Australian company and they'll contribute to your superannuation. An employer contribution typically won't cause an issue from the US side of things. It's often when it's a voluntary contribution going in, that's where the US will have a different view of your super contributions. But again, the IRS typically won't view superannuation contributions that your employer is putting in and recognise the concessional nature of that, so they won't be taking that off your income tax return. They're typically still looking at your total remuneration package and taxing it as income in the same way. That's what is usually the case. So if your employer's putting some contributions in, it may not be the same as when your super guarantee is going in Australia and it's lowering your income tax.
Okay. And then for people that have potentially been here for some time, I know that we had quite a few questions from people who have been here for quite a few years. How do they go about like reconnecting with their super? What's the process involved? Do they, if they're still living in the US, what's that strategy look like? And around preservation age and actually accessing that money, I guess, as well as part of that conversation.
Yeah, so really, hopefully you know where the super fund is, first and foremost. And if you've lost track of where your superannuation is, really the only way to find it is through your MyGov account in Australia. Now, I know it's tricky to access.
Good luck, everyone.
Good luck accessing it from the US. Those that can, that's the way to do it. If you can't, then it's a call to the ATO, and they will have the details of your superannuation, and if it's gone to Lost Super or wherever it is. So first and foremost, that's how to find it. Once you've found it, you essentially would just need to contact your super fund, and most are completely fine to be dealing with you whilst you're abroad. So if you're an Australian resident or citizen, you're under the same rules of accessing your superannuation as everyone else in Australia. So it's normal retirement age of at least age 60 or 65 if you're still working when you can access your full superannuation. So it's essentially just working out then from there whether you should be starting a pension with your super or pulling out lump sums, and that really depends on some factors with your US tax position as well, because it will be different to when you're in Australia, and it's unlikely to be tax-free in the US. As a broad
Got it. So pulling out of your super fund when you do reach that age is not the same as just sort of getting the money that is effectively yours. It can be seen in a different way depending on your tax strategy and what you've got going on in the US.
Yeah, that's right. And again, it's a grey area, and it depends on how the super's been treated in the past and your accountant's opinion. But it's very likely that a drawdown from your superannuation, whether it be a pension or if you're pulling a lump sum, is to be seen as assessable income in the US, and that means that it will go on top of your other assessable income in the US. So really, if that's the case for your superannuation, you should be waiting until retirement age if you can. And when your income is much lower, that is likely to lead to a better tax outcome, right? Because whilst you're employed, the superannuation goes on top of your earned income that you've got from employment, and you'll be paying higher tax rates. So drawing it when you've got less income is going to be more advantageous if you can.
Broadly, yeah. What about, I know we had a few questions come in around self-managed super funds and comparing that to sort of the industry and retail super that a lot of people would be more familiar with. Is that similarly sort of up in the air about how it's treated, or is there a general tendency for the IRS to treat that in a particular way?
It's highly likely with self-managed super funds that it would be treated as a foreign trust in the US, where it is treated differently to a industry super fund or retail super fund that your employer has set up for you, where you're pulled in with everyone else. Where it's a self-managed super fund, it's likely to be seen as a foreign grant or trust. And that comes with extra filing that you need to do, complex filing, which can be quite costly for your tax preparer to submit. But then also the way that the assets are viewed within your superannuation is treated differently as well, where the IRS will then look through your super fund when it's a foreign trust and say, what do you actually own within that super fund? And if it's things like managed funds, exchange traded funds that are non-US domiciled, that comes into a much harsher treatment. And but ultimately, with foreign grantor trusts, the US will look through that structure and typically tax the earnings on your tax return every year. But then there's also issues on the Australian side of things as well. So when you're a non-resident of Australian tax for at least 2 years, superannuation or self-managed superannuation becomes a lot more complex, where there's extra rules that govern where the central management and control is, who's contributing to the super fund, and it can get really ugly from an ATO perspective as well, where you're living in the US. So be really careful with self-managed super funds and living abroad.
Okay, so for someone who, I know some people may be watching this tonight or later on that might not have moved yet. Is there anything that they can prepare for their super funds before they actually pick up and go?
Yeah, so certainly in the case of a self-managed super fund, or I guess it depends on how long you're going to be in the US. If it's 1 or 2 years, sort of constructing your super strategy and paying a heap of tax and compliance and then putting it all back again may not be worth it. But if you're going long term, things like self-managed super funds you should review. If you've put a large amount of personal contributions into your super, you might need to change the asset mix within your super fund, because the IRS may be viewing that as a foreign trust as well. And that might mean that because they're looking through that structure, the actual investments that you own within your super, you might need to look at a different asset mix. And I think we might talk about passive foreign investment company treatment later.
You're the best at segues, John.
Segues.
Yeah.
But that's going to be really key to watch and potentially reconstruct your super. So yeah.
Well, I mean, this is a perfect opportunity. Yeah. I think look, there we go. The Australia.
Perfect.
It's already. I had it all queued up. So when we talk about investments and PFIC, do you want to give a bit of an intro to what exactly that means?
Yeah. So PFIC stands for Passive Foreign Investment Company, and it's a US tax term that relates to any non-US managed funds or exchange traded funds, or anything that's an indirect asset. So it could be property trusts, it could be listed investment companies. It's really anything that's not a very direct Australian company, like Commonwealth Bank or BHP, for example, or a US domiciled asset. So anything that's domiciled in the US is typically completely fine. So a US Vanguard investment or a US managed fund that's domiciled and pays their tax in the US, that's typically fine. But anything that's in an indirect type investment is typically problematic from a US standpoint. So what it means in practice is that those each one of those investments will carry an extra filing that you've got to do to the IRS. That in itself can be fairly costly if you've got a large portfolio of managed funds and ETFs in Australia. But then the tax treatment of the investment itself can be really problematic, and it's really complex in how that works. But the treatment can often mean that you pay tax on the unrealized gains each year at income tax rates, the highest income tax rate in the US. So that can end up being quite costly in itself in terms of extra tax that you pay on those sorts of investments to the IRS.
Got it. And in terms of what you should be reporting, I know, again, this is and I want to re-emphasize the disclaimer, the fact that this is not individual advice, because I think a lot of people will be watching this being what am I meant to tell? How, is there an advantage to sort of siloing some of the information, or is it just, is your general advice, you have to declare absolutely everything that happens and just sort of hope for the best and hope that you've strategized with your accountant here in the US to make sure you've optimized what actually happens from that? Yeah,
definitely don't silo. Make sure that everything is reported, and certainly if you become a resident of the US and a US tax resident, you're assessable on your worldwide assets and income. And the FBAR,
which, by the way, is anyone on an E3 who's been here more than 6 months,
exactly
hit that target. So
yeah, it's probably everyone on this call and everyone that's going to be moving to the US. You will very likely need to report all your worldwide assets and income. And even if you haven't sold, even if an investment hasn't produced any income and you haven't sold it, the FBAR, which is your reporting that you've got to do, it's likely that you'll need to at least put that investment on the FBAR. So definitely don't mess around with the IRS. They're not too kind if they find these things and you haven't reported, and there's substantial fines that can that
fall down.
You could be liable for.
I think it's a really good point, and I'd love actually you to touch on the interaction between you and accountants, basically, because I'd love to sort of just understand, like, how do you, we've done, as you know, like some of these webinars with our friend Jason, who we work with to do some information like this around the tax filing, and he sort of has the exact same advice, which is around this idea of like FBARs, for example, just tell them everything because there's no downside in telling them absolutely everything. But how does your interaction with Australian accountants here, where do you fit into that cycle, and how does someone approach you? Sort of how does that nuance work?
Yeah, so it's a good question, and it can cause confusion in terms of whether someone needs a financial advisor or an accountant or both. Accountants will be there to, obviously do the compliance and do the filing, and accountants will, certainly be able to provide specific tax advice around, certain strategies that you might be looking at. And we will typically work with accountants to put together holistic financial strategies, looking at what assets you should own, in whose name or structure to own the assets, how do we plan your cash flow, and then we're there ongoing managing investment portfolios for our clients and proactively making recommendations around the investment mix to get you to your ultimate financial goals. So we tend to do an initial strategy, and then there's ongoing advice. We unfortunately can't do one-off advice. It's really tricky to do that in Australia. But part of what we're doing is tax strategy, but we're certainly not a substitute for an accountant. You always need an accountant to file, and we certainly know our boundaries as well. The accountants are the absolute experts in tax, and they know more than I do, but I will liaise with accountants where things get much more complex when it gets into structures or trusts and things like that. So there's a little bit of overlap, but sometimes it is just an accountant that you might need to just get a bit of one-off tax advice, but where it's looking at a holistic strategy and how you piece that together to get to your financial goals, that's where I come into it to make sure that we consider all aspects of your both tax and other financial matters.
Yeah, cool. So in many cases, you'd be sort of consolidating all the information that somebody has and putting it into something packageable that they could then take to their accountants, and you'd sort of interact with them as well.
Absolutely, yeah. And in terms of, we often are a go-between with accountants, so we will often liaise with our clients' accountants on behalf of our clients to just make sure that everything's easy come tax time. So it's certainly when there is a financial advisor and accountant and they know each other and understand how everything's working, it can be just a much more easy, streamlined process because we're giving the accountants everything in a really clear, concise manner that they know and understand, which
my accountant would love, I'm sure. Cause
yes,
as opposed to the haywire, that I present. So we've talked about. The last question I wanted to ask on that, in terms of the people that you deal with. So you deal with expats. Do you deal with both the people that potentially want to move and are sort of in the early stages of planning, as well as the people that actually live abroad? Is that?
We do, yeah. So we will deal with, and I guess with the US Australian side of things, there's multiple different categories that we would look at. But it's an Australian planning to move over, and we're setting things up in a way to make sure that it won't cause problems on the US side of things, or we can make it as easy as possible on the US side of things, and then plan for their eventual return to Australia. We're looking at Australians living in the US and looking at the Australian asset pool and making sure that is on track to help them with their future goals, and again not causing US Australian tax problems where we can help it. And those coming home and then looking to repatriate back to Australia and potentially bring their assets home. And we also look after a lot of US citizens living in Australia because they'll continue to have US tax obligations and considerations to manage as well. So we look after a lot of Australians and US citizens living in Australia on a basis as well.
Awesome. So that's perfect. So we've been talking about investing in Australian super and this idea that, be careful because it can be treated differently if you do touch it, and the process that's involved there. I want to move to the sort of US side of things because I know a lot of the questions and a lot of people are looking at what should they be doing from the US side and in US retirement accounts. So I guess broadly, do or should Australians contribute to their 401ks if they're planning? Like, again, I know there's a short-term answer and a long-term answer. So what's the general advice there?
Yeah, it's something we see quite a lot where, people might think that if they're only in the US for 5 years, for example, there's no point in contributing to a US retirement account because it's just going to be too much hard work and too complex from an Australian tax perspective. Certainly shouldn't think that way. It's actually, if anything, Australia actually treats your 401k more favourably than what the US would. So it's certainly not a bad thing to be contributing to your 401k. Often it will come with matching from your employer, which if you don't contribute into the account, there's money that you just won't receive from your employer. So
It's just straight up missing out on part of the package, basically.
free money is good money, so take it. And you don't want to miss out on that extra benefit. But also the structure of a 401k is that it's meant to go in completely tax-free. The investment earnings are tax-free. It's taxable on the way out as income. So the benefits that you are likely to receive on your income tax return every year, the benefits that you get from an investment that's growing without being taxed in that period of investment and growth is really quite favourable. And then the Australian side is certainly not scary by any means, and it can actually result in an amazing outcome in some circumstances where there's a really, really favourable treatment in terms of that money. So
got it.
Likelihood.
Yeah, got it. Because even if I think a lot of people are put off by this idea, I'll get taxed heavily but either way, it's still money that you didn't have to pay for. So paying tax on it is still going to be worth it, right? That's
and you're gonna pay tax anyway, because if you don't put it in the retirement account, you pay income tax. So it often just means that it's invested and is deferred tax at worst.
Yeah. Okay. Because I think when people are applying for jobs and negotiating packages, I know one of the big differences for a lot of people that when they move over from Australia, they don't realize quite how much negotiation power you've got when you try to apply for a job here. It's not so much here's the package, do you want it or not? It's okay, I'd like to negotiate. But that can be part of your negotiation, is that the match is a huge part of what a lot of people here in the States negotiate, right?
Absolutely. In some ways it's nice in Australia that it's just set for you and people don't have to think about it. You get your 12%. But in the US, it's not officially mandated. Most employers will contribute. Yes, certainly if you can negotiate that as part of your package, it's a great thing, and everyone should be building for retirement. It's a really important aspect of your future thinking, and if it's in a US retirement account, it's still for retirement.
And the last one I've got on that one is I know 401k is the general one that that is. I know it's not the same as super, but it's kind of treated in the same-ish way from just a personal way. If you then got IRAs and Roth IRAs, do you want to quickly just give us an intro to what that actually means and how that compares?
Yeah, so the IRAs, the traditional IRAs are really an extension of the 401ks, typically. So often if you leave your employer that's contributing to a 401k, they might make you move to an IRA, which is kind of it's not an employer-sponsored account. You just might have to move it to another provider it's still in that same structure and the same concept of a 401k. Roth IRAs are different. It's where you've got after-tax money and you are contributing into the accounts with your after-tax money. The premise of a Roth IRA is that the money goes in tax-free, it's earning tax-free, it's meant to come out tax-free if you take it in retirement. These are the ones that are treated less favourably if you're back in Australia, unfortunately, because they're designed to be a vehicle that is tax-free on withdrawal in America if you take it in retirement and you've had it after a certain number of years, whereas Australia won't recognise the tax-free status of a Roth IRA.
So that's almost the inverse of super. So exactly. Roth IRA is closer to how the opposite treats super. Yeah,
that's right. So that's really something to just be aware of, because it is a very common financial planning strategy in the US that if you've got surplus cash flow and over and above what you can get into the 401k or IRA, you might look at a Roth IRA, and it's just not something that is as favourable in Australia. So just something to be aware of and consider if you're going to be back in Australia.
Okay. So we've talked about, I know we've got accounts that cover the real core of tax, but I know one of the other strategies instead of investments, like we just talked about, is around property. So whether people want to invest in property, buy in the US, or whether holding property in Australia. Do you want to talk about the comparisons of how, the tax implications that come into that?
Yeah. So I guess one of the major things to be careful of is don't assume that the tax treatment on property translates across exactly the same when you move from Australia to the US. So, if we're looking at buying a property in Australia, it's like any other investment asset in Australia whilst you're here and a tax resident of Australia. But that status changes when you move away from Australia and become a non-resident, where the capital gains treatment of a property, you don't get the 50% discount on capital gains for an investment property in Australia for Australian tax purposes. So basically the accumulated gains whilst you're living in the US are taxed at between 30 and 45% for the accumulated gains that you make whilst you're a non-resident. And also the net rental income is taxed at between 30 and 45% as well, because you don't get a tax-free threshold in Australia, and the first dollar of net earnings against a property is then assessable at 30 to 45%. So you do pay higher tax for Australian property when you're a non-resident for Australian taxes. The other thing as well, your former primary resident, be really careful that if you had a home in Australia, and this is probably the worst thing I've seen, is having a principal place of residence in Australia. That's tax-free under Australian law, but when you become a non-resident for Australian taxes, and if you sell it as a non-resident for Australian taxes, they won't recognise the non-resident status of that property, and it is backward looking as well. So even for the period of time that you were living in Australia, it will go back, not always right back from inception, but at least to 2012. So there can be quite a lot of tax that you pay in your former primary residence, even though it's actually a tax-free asset in Australia under Australian resident tax.
Okay, so that's going to cost you a lot. Yeah. So you thought you kind of had the primary residence bonus or advantage, but not so much.
Not so much, unfortunately. No.
And if you return to Australia, just to sort of flesh that complete story out, if you return to Australia, make it your primary residence, become a tax resident of Australia, does that all kick back in?
It does. It does.
Yeah, okay.
Yeah. In terms of the primary residence, it does. So you can reclaim that tax-free status again. So, yes.
Okay, and you just touched on, I believe, like that's the same as rental income. So rental income, how like the US treats that from $1 is just a matter of income. It's another source of income. It's
another source of income, and it's not. There's no penalty tax in terms of income from the US standpoint. So from $1 though, they will treat it as assessable income, and even though it's an Australian property, they will want to tax it under US tax law because you're taxed on your worldwide assets. Now you will get a credit for any taxes paid in Australia, so that can help in terms of both from a capital gains perspective and the income tax perspective. One thing to be careful of, and there's a few ways that you can pay extra tax in the US. Now there's a NIIT tax, which is basically a tax on investment income when you earn over certain amounts in the US, which can't be offset by tax credits. So that might be an extra 3.8% tax at the federal level that you might pay. And that's just on any asset. But the fact that you can't offset foreign tax credits or use foreign tax credits to offset that tax might mean that you pay kind of double tax on that money in some instances. Okay. But also the state-based taxes as well can be in addition to the taxes you paid in Australia. And Australia and California, for example, do not have a tax treaty. California doesn't care that you've paid taxes in Australia. They'll go, we're going to tax our... so it can amount to quite a lot of tax in addition to, to what you paid in Australia. And if you couple the non-resident taxes in Australia with all these other...
California or New York especially, you can be hit with a complete...
Yes.
It's all income. Yeah.
Yeah.
So that's the a capital gain on a house as well as like rental income. Like all of that would apply to this double taxation and strategy.
Correct. Yeah, that's right. So that's where being a bit more careful on where you get because property from an Australian standpoint is treated more harshly than other assets because Australia's really trying to make sure that they free up property for Australian residents, and unfortunately Australian expats get hit with extra taxes as a result. So you've really got penalty tax from an Australian standpoint, and then you lump on the extra taxes from a federal and Californian or any US state that applies state-based taxes, and it can amount to quite a lot.
Yeah, okay. In terms of the extra bits that go into, if people are still thinking about buying a place in Australia, obtaining a loan in Australia, are there particular hurdles for non-resident borrowers?
Obtaining a loan, you can still obtain a loan, but often if you've got USD income, the Australian banks are going to discount that income because they're just factoring in currency exchange risk. So they might look at 70% of that income and use that for the purposes of applying for a loan and being able to service that loan. So that's an important thing to consider, but you can get a loan in Australia. The other thing that they will look at is that if you've got a US loan, they're going to look at that and factor that into your overall borrowing capacity, but they're not going to recognise the equity of your US property because they have no recourse over that US property. So they'll count the loan, they won't count the asset, which might mean that you may not be able to borrow as much as what you would if it was an Australian asset. So.
Got it. And in terms of stamp duty as well, that's another cost that comes into the process. Is there a different treatment of Australians living abroad?
Thankfully, no. So that's an area where
one little win.
One little win, yeah, exactly. It sounds like all bad news and doom and gloom, but you're good at using those effects.
Yeah.
But so stamp duty, no, because there's a bit of a misconception out there that you do pay extra stamp duty, but that's for those that are non-residents, non-citizens of Australia. If you don't have a visa, you will pay extra stamp duty as a foreigner buying a property in Australia, but not for Australians living abroad.
Australians. Yeah. Okay. And then the last thing I wanted to ask around properties is trusts. And I know trusts get particularly hairy in the US, and especially foreign trusts. Do you want to just, I guess there's probably the US side and what's required from an Australian side in terms of what you have to have in Australia in order to run a trust? Or have be a beneficiary or what? Yeah.
Trusts, it might be effective from an Australian standpoint where, if you've got the ability to, because the benefit of an Australian family trust is that you've got the ability to distribute to different family members if it makes sense from a tax perspective, and if they're legitimately going to be the ones receiving the income and asset. So it is good from a tax planning perspective and potentially from an asset protection perspective if you've got those needs. The US won't recognise that, unfortunately. So the US tends to look through an Australian family trust, and whoever's the one that's in control and has contributed the money into the trust, they're just going to look at it as your asset, and there's extra filing. So it is more complex from a US Australian standpoint in that you've got two lots of filing, and it tends to be fairly costly filing. But it may be a strategy for you to own an Australian property, but other assets probably not. Things like shares and other assets might be more
of a pain.
Disadvantageous from an Australian non-resident standpoint.
Yep, got it. And that's larger than I thought it was going to be.
Yeah.
This is a good note from Garrow as well. The concept of the credit is, like in the US, credit and Australia are treated as like almost polar opposites. Having lots of credit in the US is treated as something that, got this capacity to borrow. In Australia, am I right in saying that like when you're borrowing, that's just seen as possible red flags for lenders?
Lenders will look, and you're right, in the US, you're told to build up a credit history and
can't describe how many credit cards I got.
Get some extra car loans and personal loans, and all of that demonstrates a repayment history.
Capacity,
Australia will look at it differently because what they're looking at is how much can you borrow and can you pay it down, and any other loans that you've got, they're going to look at that as the ability.
Possible.
Even if you've got like a limit of 50K on your credit card, as an example, the banks will look at that and go, that's extra. You could draw on that, and we're going to
Sure.
count that
Yeah.
as part of the total that you could borrow. So often the mortgage brokers will go reduce that down to its absolute minimum or get rid of that
Yeah.
credit card.
Okay, good to know. So we've talked about investments. So broadly, yeah, some investments are complicated. Houses, potentially good strategy, but needs a lot of thought. Then when it comes to just straight up like cash, I know like some people have, well, a lot of people probably have their savings and they have just money sitting in bank accounts. Are there considerations that people need to make if they're keeping cash in Australian bank accounts, just broadly?
Broadly speaking, it's not an area that's really going to cause big issues on the US side of things. So it's not a you know area that's going to catch most people out. It's really something that there's typically withholdings tax in Australia on income earnings, and that's what you would pay in Australia, and then you can use that as an offset against any US taxes. So it's a fairly straightforward area, but you just want to make sure, obviously, you're in a bank account that gives you some flexibility and allows you to get a decent return, because it can be trickier to operate from the US. And I'd say at least keep it open if you can. Keep an account open, because it is much more challenging to open a bank account when you're living in the US, and that's goes vice versa as well. That maintaining that account will just allow you to pay bills and just have a landing spot. Yeah, exactly.
Get your $50 from grandma when it's your birthday. That's
Exactly. Yeah, exactly. That's just ease of managing your life in Australia and having a landing spot for money.
So what about if what about if those accounts incur interest or accrue interest? How is that treated by the US if you're in the US?
Yeah, so that'll be assessable income in the US as well, because you are assessed on your worldwide assets. So the interest income from an Australian bank account then gets assessed in the US. So it's something that there's a bit of withholdings tax in Australia that you pay, and that's just something that should be, if you tell your bank that you are a non-resident, they should just deduct that automatically and mean that you don't need to file a tax return. But then you just show that to your US accountant. They'll assess it and then take away that withholdings tax from the US tax bill.
Got it. So it really is, again, it's about being as verbose, but like I know there's a couple of things here. There's being verbose. There's keeping in mind that your tax year in Australia is the July, June, and not Jan, December. How do they treat that? How do you do that?
Yeah, essentially, and it might be a bit trickier as well, because Australian institutions won't run calendar year statements in the way that they would run a Australian financial year.
I've done some manual Excel spreadsheets.
Exactly, and that's kind of the way that you just need to look at it. The good thing is that often with withholdings tax in Australia, it is withheld right when you pay or you receive interest. So you'll see you get interest, and then there's withholdings tax that comes straight out. So it's kind of automatic. So you just need to total up, like you're doing, Josh, in terms of running a report if you can for a US calendar year, or run it in a little Excel spreadsheet, hopefully in a simple manner, to just show all the income and tax that you've paid through the year to Australia, and then just report it to the IRS. So, yeah.
I did have one question that's come up in the chat around your superannuation. I know a lot of superannuation has life and death insurance that can be attached that a lot of people have. Is there a strategy around maintaining that, not maintaining that, or just broadly like whether they pay out if you're in the US? Are there any flags that people need to be noted of?
Yeah, it's definitely something to look at with the specific insurers and the actual company, and ask the question of your superannuation fund, or just looking at the policy statement from the insurer to see whether they will actually cover you in the US. Some will and some won't. You don't want to be paying for something that isn't going to pay out, because they will keep charging you premiums, unfortunately. But when it comes time to claim, if they don't cover it, if it's specifically excluded when you're living overseas, they'll say, well, sorry, we're not paying you out. We'll keep those premiums. So check it out. But the strategy to keep it is that if you do nothing, there's rules to say that you should be contributing to your superannuation fund. Really every 16 months there should be a contribution going in. There's a form to fill in though to say that I wish to maintain my superannuation. So you just need to opt in to the superannuation. So just make sure that you've done that if you intend to keep your cover.
Okay, cool. It's probably actually a really good flag for everyone, not only that type of insurance, but just in general, when you're moving and you become a resident of another place, all health insurances, all any insurances or anything that you're paying, ask the question like, I am going to become a non-resident for tax purposes and just non-resident. Like the term resident can mean so many different things to so many different organizations. It's always worth just saying out loud to them that like, I plan to leave. I'm going to be away for at least 2 years, say. Are you still going to pay? Like, have it in writing, go through the process because, yeah, a lot of this, you can head off a lot of pain if you present that to John and say, like, hey, I asked the question and here's what they told me. And it's like, great, you've addressed that. But I know I've spoken to quite a few people that, especially with health insurance, there's this idea that you go back, you get Medicare, everything's going to be fine. And that's not always the case. And I realize that's not necessarily related to this topic, but just in general, it's always worth when you're moving as part of your strategy. Again, be as verbose as possible, get everything in writing. What about, okay, so we were talking about Australian bank accounts. Sorry, I went off on a tangent there because I've had red flags in my head. The exchange rates. So the fact that obviously your Australian bank accounts are all going to be held in Australian dollars.
Yes.
It affects like the perceived value, I don't know, like real value, perceived value of everything you hold when you're living in the US. So are there strategies? Does the IRS look at gains and losses because of that kind of market fluctuation? What do people need to know?
Yeah, it's a really good point, and the IRS will always look at everything in US dollar terms. So basically, when for example, you're looking at a capital gain, the IRS will look at the original purchase of the asset, convert that back to US dollar terms at the time of purchase, if it was an Australian asset. And then the time of sale, look at the US dollar equivalent at the time of sale and look at the gain. So that obviously the asset value is going to impact that, but also the currency exchange, whatever happens in that period of time, can mean a larger gain or a smaller gain or even a loss in some circumstances. So everything is always, and income that you earn in Australia, that gets converted back to USD as well. So that's a really important point. But I guess it then comes into more broadly with your planning as well. So if you're someone that is permanently moved to the US, no intention to come back to Australia, all of a sudden your Australian assets are going to fluctuate, according to the asset performance, but also the currency side of things, because the likelihood is that your future financial goals are going to be in US dollar terms. So that means that you're going to need US dollars to pay for those future goals. So you need to be thinking about what's the US dollar value of this asset, which will fluctuate with the currency exchange, which can be really unpredictable. And the flip side of that is that if you're building assets in the US, but you intend to retire and live life in Australia, that it's the Australian dollar value of the assets is going to be really important for you as well. And that's so I guess the strategy around that is to really think about, and it's a hard question for a lot of expats of going, if and when you're going to move, and we always ask that, and we always say, look, we know that there's a lot of things that can impact it, and there's some uncertainty there. But if you've got the ability to answer that question, that will give you a really good indication of where you should be building your assets. If you're genuinely not sure, then it might be kind of hedging your bets a bit through building assets in both locations, and definitely don't try and time the currency markets. It's impossible. And
yeah, don't listen to people on Facebook or anyone.
No,
what it's going to do.
Commentators and amateur commentators that might say it's going to do this in the next couple of months. It's impossible because there's so much happening in the world that impacts currency exchange markets that both we can see, and there's stuff happening in the background that we can't see, that central banks can do certain things that we can't see that will shift the US Australian dollar up or down. So the best thing is to look at it from a risk management perspective rather than trying to get the optimal exchange rate.
Yeah, right. So because there is like, you can optimize like when and like the plan, and you can forecast out like when you need the money, and like, so there is a personal side to the timing and the method of which you actually transfer the money. But it's not, you're saying it's not about sort of the big, like you're not waiting for it to hit 79 because it's going to hit 79 when you wait 2 more weeks, whatever. Like it's more about the personal strategy going into it.
Correct. Yeah, that's right. And really, I mean, sometimes there's sort of recency bias with this, because I've seen a lot of people saying they're living in the US and want to move money from the US to Australia, saying, it's 68, 69 cents right now. It was 62 not long ago. Maybe I should just wait until it hits that again. It may not hit that again for 20 years. You can't wait for that. The long-term average is somewhere between 70 and 75 US cents for an Australian dollar. So it's still a really good time if you're moving US dollars to Australian dollars, judging by history. You might kick yourself in a few months if it if it moves the other way. You can't time these things, and it's impossible to do. In a perfect scenario, if you've got the ability to do so, just incrementally, slowly moving it across, that helps you kind of get different entry points into the currency exchange market, and that can work really well. So that way it doesn't have to be an all or nothing approach. You can do it kind of slowly and incrementally if you've got the ability to do so. But if you are looking at buying a house in 6 months and you need a certain amount of USD or Australian dollars and you need to convert currency, sometimes you need to just go, okay, I need certainty to be able to buy this house. Let's just move it. And the certainty is really important in terms of me meeting my financial goals. So,
Yep. So how far in advance do people start speaking? So if someone's sitting there and they're like, hey, oh my God, I didn't realize I was meant to start thinking about this so far in advance, and I haven't done this yet. What in general, and I guess, let's be real, it'd be great if you did it. What is it? A tree planted 10 years ago is the best, and the second best is planting it today. What is it just about getting in now and starting the conversation, or is there for people who aren't necessarily right up against the wall, is there a timing, or is earlier just always better?
The earlier the better. I would say, and it comes around some of these things with the currency exchange side of things, that if you can incrementally shift assets slowly, that works better rather than having this big pool of assets that you just have to move. You're right when you're moving to either location. So the earlier the better. I'd say at least a couple of years if you can help it. That just allows you to manage the tax and currency exchange and asset building side of things with time on your side, which is always favourable.
Yeah, got it. So for people that are I always use obviously for our audience, being there's a lot of Australians and a lot of people are on E3s. It's a 2-year visa. So it's effectively if you haven't already moved, start the conversation before you go. If you've gotten here, it's best to start it as soon as you can, because you don't always know, we can't always forecast exactly what's going to happen over the next few months and years. So having at least the conversation, head in the sand is not the strategy, is, I guess,
definitely
one of the biggest things.
That's right. There's a lot more levers you can pull if you are planning in advance. We sometimes have people that are coming to us and literally have a flight booked the next week, and it's this is really
you're making this up,
So we really just have to bite the bullet here and do certain things. Or if you're already in the US, you're probably going to have a tax problem, which we might be able to mitigate slightly, but we can't completely get rid of it. Earlier the better. For sure.
Okay. All right. I've now got some quickfire myths, because we had some come in, some that I just see all the time, and some of these you've actually already recapped, but I think it's always nice just to go through them again. So the first one I got is, you shouldn't invest in the US retirement account because of the tax issues when you go back to Australia. Do you want to give us 1 or 2 sentences for all of these?
Yeah. So that's a myth. It's certainly a great retirement vehicle, and isn't as big a problem as some might think in Australia.
Awesome. You can't invest in Australia while you live in the US.
You can. You just might have to do it differently to what you used to and what you would have done when you're an Australian tax resident and didn't have to pay US taxes. So maybe more direct Australian company stock rather than the Australian ETFs.
Yep, got it. The US share market has better returns, so just invest there.
I get why people might think that way, and certainly if you want to be in the US long term, it probably is the US that you would invest in, but don't discount the currency exchange side of things, and no market is bulletproof either. The diversification is always king.
Okay, awesome. Australians pay extra stamp duty buying property in Australia while living in the US.
No, that's incorrect. Australian citizen and Australian permanent residents won't pay that extra stamp duty.
Got it. Is there just to, and I know this is potentially, I'm opening a can of worms. If you have a partner who's not an Australian permanent resident or an Australian citizen yet, and maybe that's your strategy, does that just, you can just say like, yes, it's more complicated. Is it more complicated? Like kind of, does it add a little bit of a nuance?
It is more complicated, and you may look at just keeping them off the title. If you're buying a property,
Yep.
Most states, if it's your primary residence, you can add them later quite easily. Once they've got Australian permanent residency or citizenship.
Okay, but worth flagging that there is a little flag on the field for that one.
Certainly, yeah, definitely.
Awesome. I'll figure out the tax stuff when I move back.
You will likely have more options if you figure it out earlier.
Yeah.
Earlier the better. There might be things that you wish you should have done while you had the opportunity to before you moved.
Yeah, it's your money. It's kind of like, yeah, you could save more of it, or you could profit more if you, yeah.
I would rather keep more of it in my pocket rather than the ATO or IRS. So
yeah,
definitely.
My US accountant understands my Australian assets.
If that US accountant has experience with Australians, they and specialises in expats, then yep. But if they're just a generalist US accountant that doesn't have expats that they deal with, unlikely, and we've seen plenty of errors. So yeah, speak to a specialist.
I think and I'm doubling down on that, but the confusion I think sometimes comes from the fact that accountants here, even if you tell them they're Australian, if they don't know the questions to ask, there's nothing prompting them to say like, hey, have you asked whether they have a foreign trust? And if that doesn't get asked, you're in trouble, because ultimately you sign your tax return and say, I pinky promise this is true.
You don't know what you don't know, and ultimately, if you're just dealing with Americans, they are unlikely to have many assets outside of America, because why would you? So they just don't have the experience, and as you say, they don't know what to ask, and would have no idea about superannuation or Australian trust. They're very different to anything in the US. So.
Yeah, got it. And the last one I've got, my Australian accountant said I don't need to report my investments to the IRS since I'm not selling them.
Yeah, and the reverse of that is speak to an Australian accountant that specialises in expats as well, because again, it is very different to just standard Australian taxes. You again probably said it about 6 or 7 times today. But we're repeating everything. Whilst you're a US resident, everything is going to be assessable. Your worldwide assets get assessed. Yeah. Okay.
John, Versace from Apt Wealth Management. This is absolutely fantastic. I think so. Apt Wealth Partners. This has been like, I think we've covered a lot of the field, and I want to go back to sort of what I started at the very beginning, which is a lot of this is incredibly personal. It's different for individuals. So what might work really, really effectively for one might not work at all, and might be like a problem for another person. So I guess is the overarching message that, like, and I realize this is me just saying like you should call John, but like I mean it in the sense of there really is a nuance to this individual process, right?
Definite nuance to it, and everyone's circumstances are different, so there's no one size fits all to this, and get specialist help. Whether we're not appropriate for everyone, so we're always happy to tell people we're not the right fit, and here's the person that you should be speaking to. We've got a big network, but get specialist help at the very least, whether it's accountants or financial advisors. But feel free to reach out, and I'm always happy to point people in the right direction.
And that leads me to what I said at the start. There is a link here if you're watching here, and I'll put it on the YouTube description for anyone watching. Check out the YouTube description right at the bottom. John and the team at Apt Wealth Partners have offered a free 20-minute consultation to talk about your specific situation. Obviously, there's going to be plenty more than can be done in 20 minutes, but at least you can start to get that process of understanding, like, hey, what's the big picture? Is it something I need to be thinking about, or is it... I will spruik John a little bit, because the reason I pick our experts, the reason we pick our partners, is because John is someone that will say to you, like, I can't help, or like, you don't need to worry yet, or like, you don't need us now, or you might need us later. Like, I try and find partners to work with that we can trust to give, not only good advice, but they don't necessarily want to get involved if they're not going to be the experts in the field. So John, thank you again. This has been absolutely fantastic. We're already getting some wonderful comments. I will also include in the feedback forms that you're all going to get, there are some links. So there's obviously the link to the consultation, but also just some links of information that we've put together over the last few weeks and that we'll keep putting together over the next few weeks, and some checklists and some information so that you've got some ideas that you can take away from this and really get something from it. So John Versace from Apt Wealth Partners, I can't thank you again enough. This has been absolutely fantastic. If you do want to watch the recording, check it out on YouTube. We're America Josh on YouTube. We're on Facebook. We're on LinkedIn. We're on all of the channels. And check out the podcast Moving to America, because you'll hear this entire thing again. You can, while you're walking the dog tomorrow, you can listen to the dulcet tones of us talking again.
Yeah.
John, thank you.
If you want to be put to sleep, that's good. Good
John, thank you very much. Really appreciate it, man.
Thank you so much for having me, and thanks to everyone for joining.
Fantastic. Thanks, everyone.
Thanks, everyone. Thanks, John.